Welcome back to Your Money. Great to be here with you. Time for Media Week, our regular segment with James Manning, editor and publisher of Mediaweek. Mr. Manning, it's been a busy week as far as reporting season. You've been out speaking with 9 CEO and 7 CEO as well.
Yep, Tim Worner and Hugh Marks. Got some good interviews with them coming up today.
All right, well, we will actually detail those in a little while, but let's get right to it because we want to get a perspective on whether disruption makes media stocks perhaps just too difficult to invest in, put them in the too hard basket. We're joined by Loftus Peak CEO and founder Alex Pollack. Now, Loftus Peak is a global fund manager in listed disrupted businesses. He was instrumental in bringing both Seek and carsales.com.au to the Australian stock market and is an expert on how technology is changing the face of markets. Also, during his time with Macquarie, he worked on the listings of 10 Network and Asteria, so really deep history for us to draw on. Alex, welcome to the program. Thanks for joining us.
Thanks, Nadine.
Look, there's many industries that are being disrupted, but you've got to say, media is really taking it on the chin.
That's right. Well, the reason that media is taking it on, first of all, media got disrupted first. And the reason it got disrupted first is because information is of its nature, noughts and ones on a page or a screen. It's in its nature digital. I mean, cars are getting disrupted and retail's getting disrupted, but that's a kind of later development because that's physical goods that are using the digital chain to become, distributed in different ways. So media took it on the chin, took it hard first, and that is continuing. And obviously it started with classified advertising and, now it's moved into broadcast television. And obviously it is clear every broadband connection in the world is a television license because everyone that can, watch video on their laptop actually has access to their own television license. They can broadcast as well as receive. They're all channels. So those things are cutting the value of TV channels.
Now, Loftus Peak, you work globally, you look at businesses that span the world. What do you follow maybe in the media space that's been causing some traditional players maybe some heartache?
Well, the big one that we've spent time on obviously is Netflix, but we've also looked at Comcast and a bunch of others besides. Netflix is the one. Netflix is interesting in its own right, but Netflix is also interesting because it's the model itself. The model is take what was the cable bundle, which was $100 a month thereabouts, and turn that into an over-the-top bundle, not using the cable, geographic monopolies. Take the cable bundle and turn it into a $10 a month product of Netflix content, and obviously if the content's good enough at $10 a month, that's a cable company killer at $100 a month, and so that's spawning its own group of other companies. Like Amazon's got one now, Disney's now joining the fray and all that as well, so that's definitely happening.
Just on that, the broadcast business model in Australia seems to be holding up against Netflix. Do you think that'll change? Do you think this going to cut more deeply into what traditional broadcasters are doing?
Yes, I mean, I made the comment before about broadcasting licenses, and I think all of the broadcasters themselves are putting as much of their content online and available on an on-demand basis themselves, and clearly, that's, as it were, taking some people out of the broadcast business that is funded by advertising, and so the rates at which they're getting advertising for the online version of the product is very different from the rates that they're getting the advertising when they're broadcasting it. So that's creating its own economic disruption for the local broadcasters.
But for broadcasters, we often speak of the Netflixes of the world, but you've also got to take into consideration just the Facebooks and the Googles and the infrastructure that everybody is so dependent on as well.
That's right. That's why I say, every broadband connection is a TV license in its own right. So that's what you're actually dealing with, and there's this sort of drift that's going on between the big broadcast platforms into these, micro channels, broadband, and then around and over the top of that you've got the Netflixes and the Amazons and Hulu in the US and the things that are going on there as well.
Alex, you're involved in the float of Seek and car sales some time back. They both cut into, traditional media revenues you mentioned before, classifieds, things like that. Media owners themselves could have gone in and did that. Were they just slow to react?
It's an excellent question, James. And the answer to the question is it's very difficult. And you see this across industry after industry. It's very difficult for companies to disrupt themselves. And the answer to the question is simply this. Because you've got a rate for a classified advertisement, so to speak, in a newspaper. And in order to disrupt yourself, you have to start an online version of that classified, but the online version of that classified first of all cannibalises your own big classified business, and it disrupts it, or it breaks it up at a fraction of the economics that you were getting in the big as a classified product in print. And so what happens is the traditional media companies, newspapers, etc., lose big lots of revenue out of the main part of the paper in classifieds, and are not sufficiently remunerated either in terms of the revenue they get from the classified online or in terms of the valuation that they get for the classified property online to make the whole thing whole again. So you get to this situation where the media companies have to make a decision. Do I just stay where I am, milk it as hard as I can, keep the revenue up for as long as I can, or do I start to cannibalise myself at a fraction of the rate and at a fraction of the economics? And a lot of boards and managements don't have the stomach for that, because it's a 5 or 10 year process. They'd rather just ride out what they've got until it finishes and then say, well, it's the next person's problem.
And that's just the problem in media, it's the problem right across the board,
that's the
right?
problem across the
so
board.
Do you think that the worst of this disruption has happened now in the space? No.
In media or in the world?
No, in media in particular. Traditional media.
I think we are approaching peak disruption. There's a number of media properties globally, and the Huffington Post is one, and there's a bunch of very specialised media portals globally, and they're doing quite well. That they don't have print products with them. They sell access to people. They sell information. They have a distribution list. And they podcast, they vodcast, and those things can be quite vibrant businesses. But in aggregate, they wouldn't add up to $50 billion, so to speak. So no, we're not through the back end of it yet, but we're probably approaching it.
Okay.
Yeah. When you mentioned that businesses disrupting themselves, I think of Foxtel, what they're doing with KO, that low-cost sports package, where people might move out of the higher price, but at least Foxtel might keep them in their orbit, as opposed to losing them altogether.
Yeah.
I just want to mention quickly too, there's a lot of potential disruptors out there. I mean, there's startups every day of the week. How do you go about identifying ones that maybe you should get in? Do you need to get in early, or do you need to wait a little while till they've got some track record?
So we don't invest in any startups. We don't do anything in mezzanine capital at all. We're not in that end of the market. And the simple reason we're not in that end of the market is that it's, first of all, it's quite risky, point one. And point two, if you're investing in a startup, by its very nature, it can take you 5 to 10 years to actually realise the valuation. And we take money from, regular investors like SMSFs and just ordinary people that want to invest, and they might need their money in a year or 6 months, or they might need it the day after. You can't put money into a startup and expect to be able to take it out a month later because there's been something in the family that you need to deal with. So it's not that I don't believe that startups work, but they don't fit the investment profile for most people. They fit the investment profile, as it were, for rich people. Well, that's terrific. But a lot of people just need to be able to have something where they can put some money away and take some money out for their day-to-day needs on an ongoing basis. We provide that. And the reason we choose the disruptors is because, because the Apple stock price is where it is and the Amazon stock price is where it is, but there's a whole lot of others that are big companies that form part of our return over a 5-year period of it's a proper return. It's close to 20% per annum. and so there's plenty of stuff to buy in that listed space that's properly governed, that's got good quality accounts, where you can really get a feel for, you know, whether the business is good or bad and whether it's got a life or it's just someone's sparky idea. Sparky ideas are great, but they're not all investable.
Right. And so where are you seeing opportunities in disruptors in Australia in particular, or do you have a very much a global view?
So we have a very global view, but the places where so what's going on globally right now is we are moving from companies having their IT departments, and this isn't about IT, but they're moving from having their IT departments in their premises to having all of their IT on the cloud.
Yeah.
Right. So obviously when you are taking every IT department of every company and you're moving it from the premises to a cloud, that's got very significant implications for the way, you know, processing has to work in the cloud. Now, it won't be lost on many people that Moore's law is starting to break down. Because it's running up to subatomic limits. There's only a certain amount you can do to squeeze more, you know, transistors on a chip. So the way we're getting 10 and 100 times improvements in processing power is through acceleration in the data centres. And so we have spent we've spent some significant money and made some quite significant returns in companies that are doing that. Mm. So that's a very, very big global trend. It's happening in Australia too. It's a very big global trend. It's a very important trend, and there's a lot of return in it.
All right, we'd love to keep talking. Must wrap it up. Alex Pollack, thank you so much for joining us.
Thank you.
Fascinating stuff from Loftus Peak. We have to take a very short break. On the other side of that, we will hear from Nine CEO Hugh Marks. Back in a moment. Welcome back to Trading Day. Well, Nine Entertainment's half-year net profit dipped slightly to $172 million, down 1% on last year. James Manning from Mediaweek is here with me in studio. James, you spoke with Hugh Marks today, and he said he couldn't be happier.
Yeah, they thought it was a good result. I mean, I think people were expecting something really complicated, you know, after the Nine merge and all that, and they packaged it up quite well, I think. You know, they said, oh, like, here it is. They laid out the elements of the Fairfax business they're getting rid of, the events, the community media, the regional publishing, and New Zealand, which everybody expected, but they confirmed that's going to happen. Then they presented the results, how they've diversified their revenue stream from, you know, being really reliant on the broadcasting. Mm-hmm. It's gone from, you know, nearly 90% down to 50%. Okay,
well, let's hear it from the horse's mouth, shall we? Here's your interview with Nine CEO Hugh Marks.
Yeah, well, we obviously had plans when we went into the merger, and I think with everything, there's always things that are better than you expected and things that were not quite as you expected. But the really positive thing for us is those businesses that we always thought would be part of the core business going forward, they're better than what we had expected. And we can also see, not only on the cost side, but we can also see on the revenue side, already synergy starting to come through working in Nine. Joint approaches to market, joint sales deals. So it's gone, I think, incredibly smoothly. In fact, I think better than anyone could have anticipated, and we're already seeing those results come through. So, you know, I couldn't be happier with where we are today.
You confirmed what a lot of people were expecting. I think that there were sort of, I guess, three major things you're probably going to divest from the sale: the events stuff and the ACM.
Yep.
I think in the notes for the profit update, you said difficult trading conditions for both ACM and stuff in the last half. Will that impact the value you'll get for them?
No, we don't believe so. What we've done, obviously, as part of this process is built a long-term plan for each of those businesses with the local management. I think those plans are achievable. They point to very much a stabilisation. In fact, in ACM, you do get benefits next year as part of those printing deals that were done last year with News Limited. So the business will actually see growth as we go into 20. So, you know, those business models prove the underlying profitability and cash flow of those over the midterm, and it certainly hasn't changed our view on value of each of those businesses.
And you referred to this in the conference call, but I'll ask you, and these divisions are self-sustaining, they can exist profitably away from the mothership, if you like, the group savings?
They do today, particularly New Zealand. Very much a separate business, relies very little on head office. ACM been a bit more integrated into the head office business, but there's always, Fairfax has been talking about disposing of that business for some time, so a lot of that work had already been done, and we've basically accelerated that work, so it can also stand alone quite easily. There will be some interaction between our business and the ACM business going forward with printing, and there'll be a commercial agreement around that. And events, events' success is the events that are part of that. So as part of a business that specialises in events can easily go into that business. So they're all ready to stand alone and able to do so.
You've got Macquarie, I think, working on those various deals. Could I ask about a timeline for this? Look, I know these things take time, but then when you put up your hand saying an interest in Fairfax Media last year, you seem to move pretty quickly.
Look, the processes are all in place. As I said, events, we're pretty close to, I guess, some final parties. ACM and stuff, where parties are in due diligence. We expect that will take place over the course of the next month or so. And I'm certainly anticipating trying to close all of those deals, if possible, by the end of effectively this financial year, or no later than that. And of course, that's subject to receiving offers that we think represent fair value for our shareholders.
You gave a good snapshot of the new Look 9 this morning. You had the pie chart with the share of broadcast TV. I think it was 84%. You used to be, now it's down to close to 50%. That's a fairly dramatic change.
It is, and that's the merger playing out. And that's the contribution of the Fairfax businesses and Domain. It's the growth of Stan. And this digital and publishing business that we've named, and what you're seeing there is a business that effectively, a lot of people regarded the merger as an old television business and an old print business coming together. Well, actually the truth is, yes, we do have a broadcast business, but the other 50% of the business is in growth. You've got Domain, you've got Stan, and the digital and publishing business, which includes print, but print advertising revenue is 20-something% of that business and declining. That 80% of that business is, digital type revenues and in growth. Circ is part of that 80%, but circulation often these days is tied into digital products as well. So I think understanding that business, and that's been the most exciting thing for me, and I think the most difficult thing to communicate when people have a perception of that business as being a print business where the reality is actually completely different.
It's not a bad time to be diversifying, because you reported the TV revenues were down a little bit. You had a few reasons for that. TV's existed not too badly against a lot of disruptors in the media. Could we be seeing that starting to take a bit of a hold now?
Well, look, I think the underlying TV thing it's not a cyclical thing. It is a cyclical thing. It's not a structural thing. It's certainly related to perception of house prices and the economy and a sort of weaker consumer market. But we're also seeing changes in that market, and we're trying to get away from being measured as just a free-to-air business. In fact, even in the free-to-air market, it's changing as different players have different assets and different propositions to market. So I think the one thing, James, that is true is change is constant. And I think what you can see in this result is by bringing that 50% of revenue of our business coming from growth markets, we're taking advantage of that change and really positioning our business to benefit shareholders over the long term by taking advantage of that digital wave.
The move from cricket to tennis seems to have been a big winner for you in a couple of ways. I mean, you've talked about the financial savings for the business, and you look at the ratings boost Q1 seems to have get. You said best rating start in a decade, and it seems to have been a good move.
Well, evidence is in the numbers, and our audiences are up 5% year on year. That's from January 1 to last night. So a 5% lift in thousands of audience in a market that is disrupted is an outstanding result. So part of that, no doubt, is a contribution to tennis and the lead-in it gave to our regular season programming. Part of that is our regular season programming, which has all been pretty successful. Not only Married at First Sight, but a lot of the shows that are around Married at First Sight, travel guides. I think our drama, Bad Mothers, launched very well. We had a Murder Lies and Alibis factual series. All of these shows have launched to very solid numbers, and So, yeah, couldn't be more pleased with the way that the first part of this calendar year has gone.
While we're on Married at First Sight, I've just got to ask you, some speculation you might have been spending a bit of time in the editing suite, fine-tuning some of those episodes. Do you get involved that much with a show like that?
Yeah, occasionally. I mean, you know, I like to watch the shows go to air as a viewer.
Are you concerned about the content?
Oh, look, I think, you know, again, we've got to look at these things long term. What's the long-term brand value of that show? And, you know, fundamentally, yeah, okay, it is about love. And I thought the balance between some of the drama that was there and the truth of that show being about love, we need to maintain that balance over the long term for that long-term franchise. Now, that drama has created audiences, there's no doubt about it. We're seeing that growth in the show. But, you know, focusing on that long term, I think I just wanted a bit more balance.
Stan's had a big surge. It looks like it had a good summer. Summer's always seems to be its good period. I'm guessing this is probably its best summer ever.
I think good is an underestimate. Yeah.
1.5 million. You talked about the price rise. Just give us a quick update on Stan, and where do you think what's your intelligence tell you about the size of the audience compared to Netflix, and is there room for growth?
I think there is room for growth. I think the market potential, I think, you know, in the midterm we sort of regard as about 10 million subscriptions. So, you know, if you think about that as an average of one subscription per household over time, I think that's a reasonable assumption that's based on comparable overseas data. Our positioning for Stan is to seek to get 30% at least of that market. So, yeah, there is still growth to come, and I think, you know, the team at Stan have done a great job of getting the right programming mix to balance, you know, things for individuals as well as family viewing, and I think that was the benefit that we saw come through over summer.
Yeah. Hugh Marks, thanks for joining us today.
Thanks, James.
And Nine is a 50% shareholder in Australian Money Channel, which is the parent company of Your Money. So that was a good chat, James. I like that MAFS, as it appears the whole world calls it, is really about love.
Yeah. Yeah, and then Hugh was, you know, had a word to the teams and said, look, you know, let's not focus too much on the drama. Let's keep the ratio for long term.
You know, yeah, interesting.
Sense.
Yeah, it does make sense. All right. Speaking of, let's get to the ratings, shall we? This is for week 7, I should say, and this is free to air top 5. There it is, MAFS, as we love to call it, Married at First Sight. My Kitchen Rules, though, you can't keep that down, can you?
Yeah, but it's down year on year, a reasonable amount, yeah.
7 News, 9 News, and 60 Minutes doing quite well there for 9 as well.
Yep, 9's best start to the rating year in a decade.
Go 9.
You know, and that tennis was really a powerful promotional vehicle for them.
Yeah. Okay, let's go to subscription television and see what sport is rating there. We've got the Big Bash lead. We've got cricket, if we just flip over the page, and Gogglebox looking pretty good for lifestyle, I must say. I watched my Gogglebox last night. Yeah,
and that Super Rugby, the start of the rugby season, always starts pretty early in February, but did some fantastic numbers on the weekend, so Fox Sports would be pretty happy about that one. And of course, and we mentioned before, you can watch all those sports on KO now at a lot cheaper than taking out a full Foxtel subscription, so, you know, Foxtel disrupting itself, if you like, with that streaming service.
Love being forward-thinking, you know.
Yes,
you don't want to be in the position where you say hindsight is 20/20.
Yep.
And then BBC, that drama, Death in Paradise, that's the one that has Hugh Grant in it, isn't it?
No.
Oh, okay. No. Didn't watch it.
There is none of that, but it does. It's screened on free-to-air here, but the first-run episodes are on Foxtel. But and it's Saturday and Friday nights, I think, on BBC First. Saturday nights, it's nearly a year old, but it still does fantastic business.
Okay.
The ABC, those people who want to see it for free.
Put that on my list of things to watch on Foxtel.
Okay.
All right, James Manning, always a pleasure.
Thanks,
Thank you so
Nadine.
much. We'll catch up with you next week, same time, same place.